For the last 50 years, the financial establishment has treated silver as a relic. They call it the erratic younger brother of gold, a volatile asset that promises the moon but often delivers nothing but frustration and stagnation. They tell you to look at the S&P 500, to look at crypto, to look at real estate. But while the world has been distracted by the noise of the stock market's all-time highs, something fundamental, something irreversible, has broken in the plumbing of the global silver market. For the first time in modern history, we are not just looking at a monetary hedge against a dying dollar. We are not just looking at a speculative trade. We are staring down the barrel of a physical industrial crisis that the global supply chain is completely unprepared for. The mathematics of supply and demand are about to collide with the mathematics of debt and currency debasement. On one side of this equation, we have Michael Steinmann, the CEO of Pan American Silver, one of the largest silver miners on the planet. He has confirmed what insiders have feared for months. The artificial intelligence revolution is not just hungry for energy. It is devouring silver faster than the mining industry can extract it from the earth. On the other side, we have legendary natural resource investor Rick Rule, a man who has navigated every boom and bust since the 1970s. He is predicting a 75% collapse in the purchasing power of the US dollar. When these two forces collide, a physical shortage driven by the greatest technological shift since the internet, meeting a monetary flight driven by the greatest debt bubble in human history, the price of silver cannot simply rise. It has to re-rate. It has to move to a level that most people currently think is scientifically impossible. Today, we are going deep into the numbers. We are connecting the dots between the server farms of Silicon Valley and the gold vaults of central banks to prove why 2026 might be the year the silver market finally breaks. Welcome back to Beyond the Ledger. I am your host. Today, we are stripping away the mainstream narrative to expose a divergence in the markets that we haven't seen since the late 1970s. We are going to break down the AI silver squeeze and combine it with the monetary reset thesis to show you why silver is currently the most fundamentally undervalued asset on Earth. But before we dive into the deep end of this analysis, I have a request. The algorithms that control these platforms do not like precious metals content. They prefer to push tech hype, celebrity gossip, and political outrage. If you value deep dive economic analysis that respects your intelligence and helps you prepare for what is coming, crush that like button and subscribe to the channel right now. It's the fuel that keeps this channel independent. Let's start with the physical reality, because this is where the mainstream economists are getting it wrong. For decades, the narrative around silver was simple. It is a monetary metal that moves when inflation goes up. If inflation is low, silver does nothing. But that story is outdated. In a recent exclusive disclosure, Michael Steinmann dropped a bombshell that the financial press largely ignored. He stated that silver is now officially a critical metal. This is not just a label. It is a definition of vulnerability. The modern economy literally cannot function without silver. You see, silver is the single best conductor of electricity in the periodic table. It is better than copper. It is better than gold. It is the path of least resistance. If you want electrons to move from point A to point B with the maximum speed and the minimum amount of heat, you have no choice. You must use silver. For the last 10 years, the voracious appetite of the solar industry was the main story. Photovoltaic cells use a silver paste to conduct the electricity generated from sunlight. That demand alone was eating up a massive chunk of annual supply, pushing the market into a deficit. But now, a new, hungrier, and far less price-sensitive beast has entered the room: artificial intelligence. Steinmann points out that the build-out of data centers for AI is not just about pouring concrete and installing cooling fans. It is about speed. In the world of AI, latency is the enemy. To process trillions of parameters in a large language model, to facilitate the machine learning that runs autonomous vehicles and defense systems, you need connections that are instant. You need the highest conductivity possible. This means silver. Every server, every high-speed switch, every interconnect in these massive data centers requires silver. We are seeing a structural deficit in silver for the 5th consecutive year. Think about the gravity of that statement. For 5 years, the world has consumed more silver than it has produced. We have been eating into above-ground stockpiles, draining the vaults in London and New York. The buffer is gone. The cushion has been consumed. Steinmann explained a crucial economic concept that terrifies industrial planners: the inelastic supply problem. In a normal free market, if the price of a commodity goes up, the supply goes up to meet it. If corn prices double, farmers plant more corn. If oil prices spike, drillers open more wells. It is a self-correcting mechanism. But silver does not work that way. 75% of the world's silver comes as a byproduct. It is an accident of geology. It comes from copper mines, lead mines, and zinc mines. Pan American Silver is one of the very few primary silver miners left in existence. Most silver is just found while digging for other base metals. This means that even if silver goes to $100 an ounce tomorrow, the copper miners are not going to double their production just to get a little bit more silver. Their economics are driven by copper, not silver. And right now, copper mines are already running at maximum capacity with no massive new projects coming online for years. The geology is working against the supply chain. We are facing an explosion in demand from the AI sector, a sector that has unlimited capital from companies like Microsoft, Nvidia, and Google, colliding with a supply chain that physically cannot expand. This is the definition of a squeeze. These tech giants are not price-sensitive. If the price of silver triples, it adds pennies to the cost of a $1,000 chip. They will pay any price to keep the factories running. The industrial user will drain the market, leaving nothing for the investor. But if the story ended there, just an industrial shortage, silver would be a great trade, similar to uranium in 2023 or lithium in 2021. But silver is not just a commodity. It is money. It has been money for thousands of years, long before the US dollar existed. And it will be money long after the fiat currencies of today have turned to dust. This is where legendary investor Rick Rule steps in to complete the picture. Rick Rule analyzes the market through the lens of monetary arithmetic. He doesn't rely on feelings or political promises. He looks at the balance sheet of the United States. In his recent analysis, he laid out a scenario that is frankly terrifying for anyone holding their life savings in cash or government bonds. Rick predicts that over the next 10 years, the US dollar will lose 75% of its purchasing power. Pause for a second and let that sink in. Losing 75% of your buying power. That means your grocery bill quadruples. Your energy bill quadruples. Your life savings buys 1/4 of what it buys today. This isn't a conspiracy theory. It is the mathematical result of the current debt trajectory. The United States government is now paying more in interest on the national debt than it pays for the entire defense budget. There are only 3 ways out of this debt trap: default, which destroys the economy; austerity, which destroys the society; or inflation, which destroys the currency. History tells us they will choose inflation every single time. Rick argues that financial repression is the new normal. The government must keep interest rates below the real rate of inflation to burn off the real value of the debt. This is a tax on savers. It is a wealth transfer from the prudent to the profligate. And historically, when this happens, capital flees to safety. It flees to gold. Rick calculates that if the dollar loses that much value, gold must rise 3 to 4 times in nominal terms just to maintain its purchasing power. We are talking about gold at $8,000, perhaps $10,000 an ounce. But here is the kicker, and this is why we are talking about silver today. Rick Rule notes that in every previous precious metals bull market, silver outperforms gold. It is the high beta version of gold. It is gold on steroids. Historically, when the general public finally wakes up to inflation, they buy gold first. Gold is the fear trade. It is the asset of kings and central banks. But once gold gets too expensive, or once the psychological momentum takes over, the money rotates into silver. Rick Rule points out that silver usually doubles the performance of gold in these cycles. So, if gold goes up 4 times, silver historically goes up 8 times. Why does this happen? It comes down to market size. The silver market is tiny. It is microscopic compared to the gold market, and it is infinitesimal compared to the bond market or the stock market. If just 1% of institutional capital, pension funds, insurance companies, sovereign wealth funds, decides to hedge against inflation using silver, there isn't enough physical metal on the planet to satisfy that order. It is like trying to force the water from the Hoover Dam through a garden hose. The pressure builds instantly. The price has to move. It has to explode. So let's combine these 2 views. This is the synthesis that creates the perfect storm for 2026. On the left, we have the industrial thesis. The AI revolution is real, capital-intensive, and material-intensive. The companies building the future are draining the physical inventory of silver because the laws of physics demand it. On the right, we have the monetary thesis. The Federal Reserve is trapped, the debt is spiraling, and the currency is being debased to prevent a sovereign default. When you have price-insensitive industrial buyers fighting for inventory against panic-driven monetary investors, you get a super spike. You get a market dislocation where the price uncouples from reality. Rick Rule mentioned something critical. Silver is unloved. Despite all-time highs in gold, silver is still 50% below its all-time high from 2011 and miles below its inflation-adjusted high from 1980. This is what makes the opportunity so asymmetric. You aren't buying a hyped asset at the top of a bubble. You are buying a critical industrial asset at a Depression-era valuation. Rick calls this the maximum hate phase. He loves buying assets that are hated. He bought uranium when nobody wanted it, and everyone said nuclear energy was dead. He bought oil when it was negative. Now, he is pounding the table on silver. He sees the psychological setup. The sentiment is bearish, but the fundamentals are bullish. That is the recipe for a massive contrarian win. So how do you play this? Both experts agree. The physical metal is the safety play. It preserves wealth. It removes counterparty risk. If you hold the coin, you own the asset. But if you want life-changing returns, the kind of returns that can alter your financial destiny, you have to look at the miners. Steinmann's company, Pan American Silver, is a senior producer. It offers leverage. If silver prices rise, their margins expand disproportionately. But Rick Rule highlights the juniors. These are the small exploration and development companies, the ones hunting for new deposits. He argues that high-quality silver juniors historically outperform the silver price by 2 to 1, or even 3 to 1. Let's do the math again. If gold goes up 4 times, and silver outperforms gold by double, and junior miners outperform silver by double, you are potentially looking at 16 to 20 times returns on a portfolio of high-quality juniors. This is the stuff of legend. But a warning is necessary. Rick Rule is very clear about this. Most junior mining stocks are garbage. They are amalgamated moose pasture, as he calls them. They have no gold, no silver, just a good story and a promotional budget. They will go to zero. The key is finding the top 5% of companies, the ones with actual deposits, high grades, and management teams that have built mines before. In a market mania, even the garbage stocks go up, but the generational wealth is made by holding the high-quality names before the herd arrives. Steinmann mentioned that his company is constantly looking to acquire new projects because they can't find enough silver. This implies a future M&A frenzy. The big miners will have to buy the small miners just to survive. That is your exit liquidity. That is how you cash out. We are approaching a deadline. 2026 is shaping up to be the year where these timelines intersect. The inventories in London and New York are draining to critical levels. They float. The amount of silver available for sale is shrinking. The market can stay irrational longer than you can stay solvent, but it cannot ignore the laws of physics forever. If there is no silver, the price must rise to induce supply. But as we learned, supply is inelastic. It takes 10 to 15 years to permit and build a new mine. We cannot just turn the tap on. The window of vulnerability for the silver market is wide open. The industrial users are complacent, thinking they can always buy what they need. The investors are asleep, thinking the stock market will go up forever. But the math is ticking. The debt clock is ticking. The AI servers are humming. This is a bifurcated market. On one hand, you have the illusion of stability provided by fiat currency. On the other hand, you have the reality of scarcity provided by precious metals. The AI revolution is building the brain of the future. Silver is the nervous system of that brain. The dollar is the ghost of the past, haunting the economy with debt. Betting on silver today is simply betting that the future will need a nervous system, and the past will continue to fade into irrelevance. You do not have to bet the farm, but you must ask yourself, do you own any hard assets? Do you own anything that cannot be printed by a central bank? Do you own anything that is essential for the technology of tomorrow? If the answer is no, you are taking a massive risk by doing nothing. The arithmetic is on your side. The geology is on your side. The history of money is on your side. Now, it is just a matter of patience and conviction. If you found value in this breakdown, please share this video with one friend who needs to hear this. The more people understand the real economy, the better prepared we all are for the reset that is coming. And I want to hear from you in the comments. I want to know your stance. Do you agree with Rick Rule's 75% dollar devaluation forecast? Or do you think the system can hold together for another decade? Let me know your price target for silver in 2026 below. Don't forget to like, subscribe, and turn on the bell. I'll see you in the next episode of Beyond the Ledger. Stay solvent.